Hi everyone, we are now going to finish talking about Chapter 7. So this is where we left off with our first part, which is talking about the different types of bonds, including what we call government bonds. So government bonds could be treasury securities, meaning the federal government is selling debt. Treasury bills offer a pure discount bond with original maturity of 1 year or less. So you buy it for a lower price, you get a higher amount at maturity. There's no interest payments in between. Treasury notes are coupon debt with original maturity between 1 and 10 years. So now you're receiving interest payments. And these are on page 213. And then we have T-bonds, treasury bonds, which are coupon debt with original maturity greater than 10 years. So again, interest payments. Then we may have municipal securities that our local governments and state governments may offer. Okay, and they have different types of default risk depending on who's selling them, the chances of you not receiving your money, bondholder, and they are also rated. Now, interest received on state and local bonds, securities, is tax exempt, so it's not taxed on your federal tax return. So sometimes we start to look at, which is better? Which should I purchase, a corporate bond or a government bond? So a taxable bond has a yield of 8%, so that's what it's going to make. And a municipal bond has a yield of 6%, so which one should you buy? Well, if you are in a 30% tax bracket, be careful. You are going to pay a 30% tax on your bond interest. So they use percentages there to show you the impact on the interest rate. But do it this way. Say your bond is $1,000. You're going to earn 8% interest. That's $80. Well, of that $80, you're going to pay 30% of it as tax, or multiply by 30%, $24. So of the $80, 24 gets paid as tax, so subtract it. You're only making $56 in actual money. Divide that $56 by the bond amount of $1,000. So how much interest are you actually making? 5.6%. Where if you buy a municipal bond, which has no tax rate, okay, then you will make 6%. So sometimes we have to be careful. We've got to see, is this going to be taxed? Now, you can find the tax rate that would make it indifferent. In other words, the taxable bond would have a yield of 6%, the same as the municipal bond. So if the current current coupon rate on the bond is 8%, you multiply that by 1 minus your tax. Well, we know the result would be 6%. So at what tax rate would it make sense to invest in either bond? And that would be if your tax rate is 25%. So if you take the yield, I should say, not the coupon, the yield times 1 minus your tax rate, that'll tell you your actual yield after tax. And that's what you're computing there. Another type of bond is called a zero coupon bond, meaning no interest payments are made over the life of the bond. However, the purchaser or the seller of the bond sells it at a deep discount, much less than its par value, and pays par value at the end. So The difference between how much it is sold for and how much is received at the end is the interest. It's just received in a lump sum. So the entire yield to maturity comes from the difference between the purchase price, which is going to be much less than that par or principal received at the end. These won't sell for more than par. And these are sometimes called zeros or deep discount, or even original issue discount bonds. Those are just terms we use to describe them. Treasury bills and principal-only treasury strips are good examples of zeros. Now, before we talk about floating rate bonds, take a look at how we determine the interest on zero coupon bonds. Page 214. In this example, the bond sells the $1,000 par value. So the bondholder will receive $1,000 at the end. I'm going to go back to this prior slide so you're not going through. What does it sell for today at the beginning of year one? $508.35. So the difference between the $508.35 and the $1,000 is the interest. Buy it for $508.35. You're not going to receive interest over the life of the bond. You're just going to receive it all in a lump sum at the end, $1,000. Now, the way interest used to be recorded on that deep discount is we would say, how much is the total discount? $1,000 minus $508.35, or $491.65. Well, a bondholder would recognize interest, what we call straight line. They would say, how long is the bond for? And in this case, it's for 5 years. So divide that by 5. So each year, the bondholder will recognize an income, $98.33. However, the rules have changed a little bit. Now, let's see. 2% maturity, total interest paid over the life of the bond is, okay. The other way of determining interest, which is what is used now, is something called implicit interest. And instead of just saying, well, what's the total interest? $491.65 divided by 5, recognize $98.33. We need to determine what is the interest rate these bonds actually were sold to yield. Now, if you have your finance calculator, which is suggested here, you want to use your finance, go in your apps, time value of money. Your N is 5. You need to know your interest rate. The present value is what they sold for. So I'm going to put that in as negative $508.35. There is no payment. The future value is $1,000. So I'm going to put that in as positive. Then I'm going to go back up and solve for I. So it comes out to be 14% interest. 14.5 it looks like. Oh, okay, I see what they're doing here. Now up in the example, up in the top, let me see, 508. Oops. 508.35 times 14%. Okay. Up in the top, if we, I'm not using the information down in the wording. I'm looking at the table, and here's what it's saying. We're assuming, and you could write this in there, this is a 5-year bond that pays interest at the end of each year. Not pays interest, but interest occurs at the end of each year. So each year we need to determine what's the total amount of interest. Well, we just figured out what these bonds sold to yield, 4.5%. How do we determine implicit interest, meaning how much interest occurred from the beginning of the first year through the end of the first year? Take the beginning balance of the bond, 508.35, multiply it by that 14.5% interest rate. We're off a little bit because of rounding, but I get 73.71. Let me see if they use 14.48. Probably. Yeah. 14.4. Yeah. So just because of rounding, we're off a couple pennies. That's okay. What does this mean? When the company recognizes that interest, it increases the value of the bond from 508.35, add 73.66. So next year, when we're calculating interest, use the new balance of the bond times 0.145, $84, and I get 39 cents. We're off a couple pennies. So you use the new value of the bond to calculate the new interest, value being prior balance plus the implicit interest. So the company selling the bond would show interest expense of that amount in the implicit interest, and the company buying the bond would show interest revenue. And that's how you have to recognize interest on zero coupon bonds. Another type of bond is a floating rate bond. So the coupon rate floats depending on some index value. So this is on page 215. They usually base it on the Treasury bill interest rate or 30-year Treasury bond rate. So these types of bonds usually sell at their principal or par value because the interest on them is close or not, if not close, at least at market. So the adjustable rate mortgages and inflation-linked treasuries are some example of these types of bonds. There's less risk with these floating rate bonds because the floating rate, it is likely to not differ substantially from yield to maturity or market. Coupons may have what we call a collar. They may be capped. So that means the rate, the coupon rate, the amount of rate of interest that the bond pays will not be able to go above a certain amount or below a certain amount. And that's talked about on page 215. Other types of bonds that could be sold are for catastrophes, and they talk about Katrina here. Income bonds, which are similar to conventional bonds, but the coupon payments depend on a company's income. Convertible bonds. These are bonds that could be swapped out for stock of the company instead of cash. A put bond. This allows the bond or allows the bondholder to force the company issuing the bond to buy back the bond at a stated price. And then there are many other types of provisions that can be added to a bond, and many bonds have several provisions. It's just important to recognize how these provisions affect returns. They talk about reverse convertible bonds and death bonds. I like these. Death bonds are where insurance companies create bonds with life insurance policies of people who only have so long to live, and then people buy these bonds. The bonds are paid off when the people die. Crazy, right? So take a look through all those other types of bonds and the characteristics, and just let me know if you have any questions. I hope I'm pronouncing it right, but Sukuk bonds, these are created to meet a demand for assets that comply with Sharia or Islamic law, because Sharia does not permit the charging or paying of interest. Okay, so you could read about those on the bottom of page 216, just letting you know more about different types of bonds. So these are typically bought and held to maturity, and they are extremely illiquid, meaning once you buy them, you're holding on to them till they mature. And there's no interest payments. Okay, so those are our different types of bonds. Now let's talk about the bond market. As we talked about back in chapter 1, the bond market is primarily over the counter, so it's electronic, with dealers connected electronically. There's a lot more large number of bond issues, but generally low daily volume in single issues. So they talk about this on page 220. The reason is because there's a lot of government bonds being sold. So the government is involved in this more than in the stock market because they're selling debt. So it makes getting up-to-date prices very difficult. It's not as transparent of a market as the stock market is. Okay. The only exception is Treasury securities. So if you're on page 220, they talk about that. Now, in 2002, the trading reporting and compliance engine was created. And now bond dealers are required to report on that. So if you look in the finra.org, you can learn more about TRACE. Here's what we want to know. TRACE bond quotes, okay, are available at our finramarkets.morningstar.com. And an example of what you will see on that webpage is on the top of page 221. So this is where we're seeing bond quotes. So I will ask you to go to that page if you aren't there already. You could see there's the name of the company that's offering the bond, the symbol, the current coupon rate, so what the bonds are paying in interest payments, when the bond matures, the Moody bond rating, if it's AA, AAA, B, C, the high price it's sold at. Now remember, any price above 100 is it selling for a premium or above 100%. Any price below 100% is being sold at a discount or below its par or principal. So it tells you the highest it's been at, the lowest it's been at, the last price, and how much it's changed. And then what it's selling to yield. So what is the current market or yield on the bond, that bond itself? On page 222 is a sample of how the Wall Street Journal reports notes and bonds. So the maturity date is listed, the coupon rate of interest, the dealer pay is the bid. So that's how much the dealer is willing to pay. Remember, it's all dealers in these types in bonds. Treasury notes and bonds are listed there. The asking price. So that's how much a dealer will sell the bond for, how much it changes, and the asking yield. Now at the bottom of the page, on the 11/15/2046, the very last item, I have this underlined for you too. Where is it? I did have it underlined. There it is. On page 221, it's the second to the last paragraph. It says the very last ordinary bond listed is often called the bellwether bond. This bond's yield is the one that is usually reported in the evening news. So when you hear that long-term interest rates rose, what is really being said is that the yield on this bond went up or went down. Okay, so that's really what they're quoting, that very last bond on the list. Interesting. So what is the coupon rate on the bond? When does the bond mature? So the bond matures, the coupon rate is the 4.5%. The bond matures on 2/15/2036. The bid price, 128.0781, is the most a dealer will pay for it. The ask price is 128.1406. That's the most they would sell it at, the dealer. How much did the price change from the previous day is 0.7031. And the current yield What is the yield based on the ask price? You will ask price 2.618. Clean versus dirty prices. The clean price of a bond is the quoted price, how much it would sell for if the interest payment period just started. The dirty price is what a price will actually, or the price actually paid. The dirty price will be different than the clean price if the bond is sold during an interest payment period, because the bond will sell at its quoted price plus interest that has occurred on this bond from the last interest payment date to the selling date of the bond. Let's look at an example. Consider a treasury bond with a 4% semi-annual yield and a clean price of $1,282.50. The number of days since the last interest payment are 61 days. There's the number of days in the coupon period are 184. Now, the T-bond's face value is $1,000. So normally, interest is paid at $1,000 principal times a 4% semi-annual interest rate. So 1,000 times 0.04, $40. However, 61 days have passed since the last interest payment. So the current bondholder is entitled to that $61 of the 184 days. So 40 divided by 84 times 61, the current bondholder who is selling that is entitled to $13.26 of that future interest payment. When the bond interest is paid at the end of 184 days, they don't go, oh, let's send a check 61 days of it to the old bondholder and no. Whoever owns the bond on that 184th day gets all the interest. So to make up for that, the bond will sell at that $13.26 of interest that the seller is entitled to, plus the quoted price. So the dirty price of the bond would be $1295.76. So that's what that means. Now, we haven't talked about inflation, and you remember this from your economics class, and interest rates. And you dealt with interest rates probably in your economics class. So let's review this. When we look at interest rates, we need to account for inflation. So remember, a real rate of interest is measuring how it includes the change in purchasing power. So it's adjusted. The real rate of interest is adjusted for inflation. Nominal rate of interest is your quoted rate of interest. And it doesn't account for inflation. It's just the change in actual number of dollars. The ex-ante nominal rate of interest includes our desired real rate of return plus an adjustment for expected inflation. So I'm going to take you to page 223 to make sure that you understand what we're talking about here. Bottom of page 223. To see the effect of inflation, suppose prices are currently rising by 5% per year. In other words, the inflation is 5%. An investment is available that would be worth $115.50 in 1 year. It costs $100 today. Notice the interest rate is 15.5%. Okay? But we did not consider the effect of inflation. So this is the nominal interest rate. So it's just measuring your interest rate based on change in dollars. Okay. To answer, so what is the impact of inflation here? To answer, suppose pizza costs $5 a piece at the beginning of the year. With $100, you can buy 20 pizzas. Because the inflation rate is 5%, pizza will cost 5% more at the end of the year. Now, if we take the investment, how many pizzas can we buy at the end of the year? So of the $115.50 that we'll have at the end of the year, we'll only be able to buy 22 pizzas because the price of them increased $5.25. So our pizza rate of return is 10%. We could buy 2 more of 20. 2 divided by 20, 10%. So how much did our purchasing power increase? 10%. So this shows you how we determine nominal versus real. So we can say in this example, our inflation rate is at 1.01, 1.05, and the actual dollars we'll get, the nominal dollars, is 115.50. So what would be our investment in terms of real dollar value? $10. So our investment would increase by $10. We invested 100. So it's a 10% not real interest rate. So that's your inflation rate. That's how you would determine it. The Fisher effect, okay, shows us our relationship between these rates. So it states, because investors are ultimately concerned with what they can buy with their money, they require compensation for inflation. So what is this relationship? 1 plus the nominal rate, the rate without any inflation adjusted for it, equals 1 plus the real rate times 1 plus expected inflation rate. So that is how we can determine the real rate of interest, the nominal rate, by that formula. We could also approximate the nominal rate by taking our real rate, which is adjusted for inflation, plus the expected inflation rate. So let's look at an example. If investor requires, this is on page 225, if an investor requires a 10% real rate of return, okay, so remember the real rate of return is already adjusted for inflation, and the inflation rate is 10%, what must be the approximate nominal rate? So the approximate nominal rate would be 10 plus 8. The real rate plus the expected inflation rate, or 18%. But that's just estimating it. We could use this formula to determine the actual nominal rate by taking 1 plus r, which is what you're solving for, equals 1 plus your real interest rate, which is 10%, times 1 plus r. So 1 plus r equals 1.1880. So you subtract the 1 on both sides. So your interest rate, nominal rate in this case, would be closer to 19%. So because they want a real rate of return, but it's the nominal rate of return that they're using in their investment, they want to determine what is my true, what should I have my investment out? What nominal rate should it be at? 18.80%. Okay, so there's a great inflation and present value example that I encourage you to go through so that you can see how the nominal rate and the real rate can be used to determine different things. So one question that comes up is the effect of inflation on present value calculation. So take a look at how you can incorporate inflation rates into your present value, and make sure you post any kind of questions you may have on that if you can't follow that. I'm now going to move on to the term structure of interest rates. So I'm on page 226. So this is comparing the relationship between short-term and long-term interest rates. And they'll generally be different. And there's a great graph on page 227 that shows you the difference between them from 1800 through 2020. And this is the term structure, though, is the relationship between time to maturity and yields when everything else remains equal. So those are the only things that are changing. It is important to recognize that we pull out any of the effects of default risk, different coupons, any other thing that could be different. We're just focusing on time, maturity, and yield. Time to maturity and yields. So I'm going to read through some of this in the book and point out some items. Bottom of page 226. The relationship between short and long-term interest rate is the term structure. Okay, and we just defined that. We said we're going to ignore some other items. Next paragraph down. When long-term rates are higher than short-term rates, we say the term structure is upsloping. When the opposite is true, we say it's downsloping. So when short-term rates are higher than long-term rates, it's downsloping. So it's just the words we use to describe that relationship. But what determines the shape of the term structure? There's 3 items. The first 2 we already discussed, the real rate of interest and the rate of inflation. So remember, the real rate of interest is the compensation investors demand for forgoing the use of their money. So they could have used that money and bought something. You could think of it as the pure time value of money after adjusting for the effects of inflation. The real rate of interest is the basic component underlying every interest rate. So that's what people want to be compensated for not using their money to buy something. That makes sense. And this is always the beginning point for an interest rate, regardless how long that person's money will be used. When the real rate is higher, all interest rates tend to be higher, and vice versa. So the real interest rate doesn't really determine the shape. It's future inflation that strongly influences the shape of the term structure. So there's our second. So real interest rate is our starting point, okay? And it has the same effect on interest rates. It doesn't account for a slope. Slope is determined by inflation. So the shape of this. Investors thinking about lending money for various lengths of time know that future inflation erodes the purchasing power of their dollar. So maybe today they could take that dollar and buy 2 pieces of paper, but in 3 years they're only going to be able to buy 1 piece of paper because of price increases or inflation. So as a result, Investors also want compensation for this inflation, and this is called inflation premium. So that's another component of interest rates. If investors believe the rate of interest will be higher in the future, then long-term interest rates tend to be higher than short-term because they want more compensation. So an upward sloping term may reflect increases in inflation and vice versa. So that's the impact inflation has on the interest rates, long-term and short-term. And the last component is interest rate risk. Remember, the longer-term bonds have much greater risk of loss because the money doesn't need to be paid back for a much longer period of time than a shorter term. So another component of interest rates is interest rate risk premium because of how long the particular debt is out there for. So the longer the term to maturity, the greater the interest rate risk. So that interest rate risk premium increases. It increases with maturity. However, interest rate risk does increase at a decreasing rate. So it doesn't go up. It increases, but it doesn't do so at a straight line, but more of a slope at a decreasing rate. And you could see a picture of this on page 228. So when you have an upward sloping term structure, meaning long-term interest rates are greater than short-term, your real interest rate is constant, but the inflation premium is increasing because the assumption is inflation is going to go up. And your interest rate risk premium is also going to increase as your time to maturity, but it doesn't do so at an exact rate. It does it at a down sloping rate. So those are your different components of your nominal interest rate. Where if it's a downward sloping term structure, and there's the picture there. Now you're downward, real interest rate is constant because it doesn't have an impact over time. But if your inflation premium, so the thought is that inflation will decrease over time, okay, then the inflation premium will decrease as maturity goes out farther. So the interest rate risk premium, although it increases at a decreasing rate, okay, it will be on a downward slope because the inflation premium is on a downward slope. So it's just showing you all three impact your nominal interest rate depending on how people feel about inflation and depending on how long the bond is, or the item I should say, is to maturity will impact that interest rate as well. So I wanted to make sure I went through that because the PowerPoint doesn't do it justice. We want to make sure you understand why long-term rates will differ from those short-term rates, and it's all based on those three components. The final item in your chapter talks about bond yields and the yield curve. Okay. And there's a picture of this on page 229. Okay. Now, on page 229 is the Treasury yield curve. Treasury notes and bonds of different maturities don't have the same yield. So each day, in addition to Treasury prices and yields, the U.S. Treasury provides a plot of Treasury yields relative to maturity. And it's called the Treasury yield curve, and you could see it there. And they provide you, that's the one on December 29th's quote. Okay, so note the yield curve available on U.S. Treasury will display both the nominal and real yield curves. So the top one is the nominal with the circles, and the bottom one is the real. So nominal, that's your yield without looking at any inflation adjustment, where the bottom one has an inflation adjustment. Okay. Treasury notes and bonds have three important features that we need to remind you of. They are default free, so there's no default risk. They are taxable, so there is a taxable premium, and they are highly liquid. So they're what called a liquidity premium. This is not true of bonds. So when we are looking at bond yields, we need to remember that the real rate of interest is the first thing that impacts them, because that's constant. Expected inflation premium will also impact the interest rate. And then just because of how long the bond is out there for, that's our default risk. And then the change in interest rate also provides an interest rate risk. So the interest rate in total, the bond yield, includes all these different components, as well as a taxability premium. So as we said, bond interest is normally taxed. So included in the interest rate is what the bondholder wants in compensation because this thing is being taxed. And finally, there's a liquidity premium. Investors prefer liquid assets to illiquid assets. Bonds are usually illiquid. They're harder to sell, or not as easy to sell, I guess. That's the way you could say it. It's not as easy to sell. So there's also this component included in the interest rate. So we're just letting you know how this interest rate is developed, how it comes to be. There's what we demand in our real rate of interest. Real rate of interest is interest adjusted for inflation. There's even a premium for future inflation risk because the bond is maybe out for a couple years. Interest rate risk because of changes in interest rate that could occur. Default, that maybe the bondholder won't receive their money because of how long the bond is for. So as the maturity increases, the time, the long-term period, these items impact the nominal rate of interest that the bond will yield, and then the taxability and liquidity premium. So we just want to make sure you understand how these types of items will impact interest rates. Long-term interest rates would be, or interest rates on long-term investments, debt, will be more impacted by these than short-term investments. So just to practice what we looked at back in the beginning of the chapter, what is the price of a $1,000 par value bond with a 6% coupon rate paid semi-annually if the bond is priced to yield 5% and it has 9 years to maturity? So you could use your formulas. You could use your finance calculator. I'm going to use my finance calculator. Again, remember there's two components to a bond: the principal payment at the end and the interest payment. The first thing you want to do is calculate how much interest this bond pays over the life. 1,000 times 6%, or $60 a year. But since the interest payments occur twice a year, 6/12, each interest payment will be $30. How many interest payments will there be? 9 years, twice a year, 18. What interest rate should we use to determine the present value of these interest payments? 5% divided by 2, or 2.5%. Always use yield or market. So I'm in my finance calculator. My N is 18. My I is 2.5. I'm calculating for present value. My payment is 30. I also know my future value of my bond payment. So I can calculate this in one step on my finance calculator. My future value will be the present value or par value, or I'm sorry, not the present value, the principal or par value. So make sure there's $1,000 in FV. Then go up to PV, alpha, enter, and you should get $1,071.77. So it sells above par, which makes sense because the coupon rate is more than the yield of 5%. Now, if the yield rose to 7.5%, we would change the interest rate to 3.5. Everything else is going to remain constant. 3.5 would be 7% divided by 2. Now solve, and you would get 934.05. The 934.05 makes sense because this would sell at less than its par value. Why? Because the market interest rate is more than more than the coupon. In the last part, they want to know what's the current yield on the bond if the yield to maturity is 7%. Well, that means the 7% we just used would cause a purchase price of $934.05. To determine the current yield would be the annual, what is the annual coupon payment? $60, 30 each interest payment period, divided by what the bond sold for of $934.05. So the current yield would be 6.4%. Okay? So that concludes our discussion of Chapter 7. Please make sure you post any kind of questions you may have to the discussion board.